Hi, everyone. Thank you for joining me again for another episode of the Optimized Wealth Podcast. My name is Lance Norquest, investment advisor with Bellwether Wealth, and today I'm joined by Alan Beaulieu, a longtime economics forecaster who spent decades helping business leaders understand where the economy is heading and how to plan for it. Alan, welcome to the podcast.
Thanks, Lance. It's great to be here with you. And I think we're going to do a lot of good together.
I think so too, and I look forward to having you maybe on some future podcasts as well. At any rate, Alan and I kind of talked beforehand, we wanted to have our first subject, if you will, be something current. And we've seen it a lot in the headlines, at least over the past month or so, and that's been oil. Oil's really been a big topic that's been discussed. A lot of it, it's really all stemming from the conflict with Iran and the war that started and really the Strait of Hormuz being shut down. But, we've seen the price of oil fluctuate quite a bit. This morning, it's a little over $110 a barrel right now. So not as high as we have seen it, but obviously not where we were prior to the war beginning. But Alan, I think a lot of the questions and concerns that we hear and see right now, especially in headlines and also conversations with some clients, is what are some of the economic risks that we could see if this war extends another couple of months? Because we hear President Trump say it's going to be weeks and not years. So let's just start there.
Yeah, and that's an interesting place to start because today's announcement was their civilization was going to end tonight. So, I mean,
Mm-hmm.
that's, this has been dragging on for a while already. So, let's assume that that doesn't happen tonight, that we don't obliterate them and everything that's involved with that. What goes on is pain, economic pain, and there's no way around it because of the importance of the Strait of Hormuz, which you accurately presented. Um, right now, there's a shortage of oil of about 11.1 million barrels a day. 9 million barrels a day are chewed up by Europe. When we look at the UK, France, Germany, Spain, and Italy combined, they use about nine. So if you want to just kind of think of as that last tanker arrived in the UK, there's no more oil coming in. So you have an important economic center, if you just want to block it off mentally that way, it's not how it actually happens. That's a lot of problem. That's a lot of economy that's not going to be fueling our economic growth or global economic growth. And right now, it's actually in Asia where most of the problem is, but I think as Americans, we can picture Europe better than we can Asia. But if we move to Asia, and we look at some numbers from Bloomberg, what we see is that there are some major nations that are at risk of having insufficient oil. They're already started rationing. They're already started prioritizing, and their economies are going to slow. And there's some key ones. India is going to be one of the worst hit. It's in the top four, I believe, of nations that Bloomberg is saying will feel some real pain from this. That's a major economy and supposed to be an ally. Japan is two down from there, number six. They will be hurt. And they're making plans accordingly. And we depend upon Japan, and Japan depends upon us. And so all this means, and I guess that's my long-winded way of saying this, not just it might happen, it is happening. And we know the trade we do with these nations. We know the trade that we do around the world. And if their economies slow down, as Americans, we like to think we don't need them. But the reality is we're part of a global economy and we do need them. And all of this is just going to cause an economic slowdown, slower growth in 2026, while causing inflationary pressures because prices go up on consumers in other parts of the world more than the US, but they are going to go up here. And certainly on the heavy crude coming in, we're going to see it on the industrial side in this economy too. So we're going to have slower economic growth with some inflation. So, my friend, my thought to you is pretty simple. Knowing that the end of the world is near, what do you do with that? I mean, I'm glad I'm not you. I'm used to telling people, get ready, duck and cover, and make sure you got cash on hand. But you're dealing with people's futures in their lives. I help people with businesses. You help people in an entirely different way. So, given what I just said, and the likelihood is not going to end real soon, how do you sleep at night, Lance? And what do you do?
Yeah, I think, the first part is we want to make sure that we approach this using data and economics and not necessarily watching the headlines and reacting emotionally. Um, and I think that's one of the first places to go. Secondly, it's important to make sure that, as an investor, everyone's a little bit different. We're going to have different risk profiles, different investment objectives, different risk tolerances. And, so everybody's plan is going to look a little bit different. But if you have that plan, the important thing is to stick to said plan. Now, if you're maybe investing things on your own, so self-directed, or even working with your another investment advisor, uh, my general thoughts on where you should look during this type of economic event or these types of conditions is, and before I begin, I should say that don't take this as investment advice. This is just general conversation, of course.
Two guys talking.
Exactly, exactly. For compliance purposes, this should not be looked at as an investment recommendation. With that being said, I would really favor quality over cyclicality. As growth really slows and inflation, if it stays sticky or gets even stickier than we've had in recent years, markets really prefer businesses with strong balance sheets and stable cash flows. So again, I would really consider high quality, value-based companies with stable earnings over the highly leveraged cyclical companies. Again, we've seen a lot of those types of companies in recent years, the Magnificent Seven or all of those around the artificial intelligence boom really take off. So it could be that you don't necessarily need to exit that entirely, but it could be a good time to take some profits in that space for sure. Another option is you could own some inflation protection, but I would make sure you keep this sized appropriately. So whether that's a mix of maybe some short duration fixed income or cash, Alan, as you mentioned earlier, or some T-bills as well. These can all help. For those that don't know, bonds and interest rates have an inverse relationship. So if we start to see inflation go up and interest rates rise, we're going to see market value of bonds go down. And the longer the duration is of your bond portfolio, the more magnified or more impacted your bonds are going to be. So that's why we recommend having a very short duration. I would look at maybe three, no more than 5 years from a duration portfolio standpoint in the bonds.
Well, that makes a
Uh,
lot of sense. Uh, when I talk with people, you know, when you said don't run to the headlines or don't act quickly based upon the headlines, that seems to be the natural reaction, though, with a lot of people. You know, they
mhm.
see oil going up. How do I take advantage of this? And to me, that's you can, but the risk is incredible because things can change overnight, and all of a sudden, well, it won't be all of a sudden on the oil prices, but uh, you could be betting on this horse to find out another horse wins the race, and it becomes very difficult, I think, to pick the winner in these unsettled circumstances. I mean, do you think I'm off base with that?
Yeah, it's one of those things that we all have emotional biases as humans. And when we, again, just for this year alone, we saw energy skyrocket after the announcement of the war on February 28th and just the impact of the price of oil. And a lot of individuals start to think, wow, man, I should move into energy. It continues to go up and up. But the reality is you're already starting to chase return at that point. Could you shift into something like that and continue to see some of the upside? Yes. But at the end of the day, you're also playing a timing at that point, and it's very difficult to time markets. So I would encourage you to look at having more of a diversified portfolio. So, kind of another key piece here is, when you're looking at your investments, if you already have a sound allocation in your portfolio, now could just be a great time to rebalance and do so without acting emotionally. Again, don't chase oil or don't chase the energy sector. Do a rebalance, take some profits, trim where things have become oversized in the portfolio, and then just make sure everything's back in line with your plan, as I mentioned earlier. You're going to have, if you have a sound, diversified portfolio, you're going to have exposure to the energy sector and others that have done well. But by taking out of things altogether and getting concentrated, that's where you start to see a lot of risk in the portfolio.
That makes a lot of sense to me. When you mention you're going to have some energy, but you don't want to be overbalanced because
Exactly.
your risk is going to be outsized. And for a lot of us, that's just not acceptable because we don't get two or three bites at the apple as as we get older. So makes a lot of sense. If I may sum up where I'm at, I think we're going to see the oil problem continue for a while, and the global economy is going to be feeling pain for a while. Because I don't think this is going to end real quickly. And even if it ends in a month, there's still repairs to be made and production be brought back online, and normalization will take a while to be brought about. So I think everything you said is not just applicable for today, but will be applicable for months to come as we hopefully head toward normalization.
I agree. The oil supply, it's not like a faucet where we can just turn it on and off. Again, they have to rebuild the supply again, any infrastructure that was damaged or destroyed. So it could take several months. Again, just kind of depends on the duration of the conflict itself, too.
Yes, absolutely. Strange times we live in. Good to be you.
Strange times for sure. Well, Alan, before we sign off, is there anything else you can think of, last minute thoughts or key takeaways that we could share with the group?
No, when it comes to things like what we're talking about now, there's no long-term leading indicator, even intermediate leading indicator that will help. Uh, I was looking at the U.S. dollar today, and it's saying it's strengthening, but it's still below where we were when we started the year. So people are going to say, "Hey, the dollar's up 2.2%," and they're not going to talk about that. It's still below where we were, at the beginning of 25. So my advice is the same as yours. Ignore the headlines and just, dig deeper, see what the longer term trends are going to be, because that's where the safety is.
I
And good
agree.
returns.
I
That's
agree.
all.
Again, if I was to summarize, I would say from an investment standpoint, again, I'm going to sound like a brokered record, but emphasis on quality, liquidity, and short duration. And then obviously, to sum it all together, diversification is going to be your best friend in volatile environments like this.
Absolutely. Absolutely. And if in the future we get to talk about more things, I'm sure the world will give us plenty to talk about.
I think you're absolutely right. Well, for our listeners, if you have questions or would like to discuss how to diversify your investment portfolio, or to kind of mitigate volatility around oil prices and the economic impacts associated with it, of course, feel free to reach out by calling our office at 402-476-8844 or by visiting our website at bellwetherwealth.com. And that's all for today's episode. Thank you for watching. Again, Alan, thank you very much for joining me. My name is Lance Norquest, investment advisor with Bellwether Wealth, and we'll see you next time on the Optimize Wealth podcast.